Welcome back, everyone. I hope you're having a great day as always. And in this episode, we have to discuss three of the leading Chinese tech companies that JPMorgan believes are in a great buying spot at their current level. After the recent market rotation away from the big tech names and more into the traditional value plays, these big tech companies operating in the Chinese market have seen major declines from their 52-week highs. And the analysts at JPMorgan Chase, the largest American financial institution, believe that these falls are actually overdone and that there's pretty decent value coming in from these Chinese tech companies at their current level. And after recent news earlier in 2021 that Americans will not be banned from investing in the big name tech firms such as Alibaba, Tencent, and Baidu, we're going to take a look at some Chinese tech companies that may offer a ton of value at their current level with a lot of upside potential and very little risk of getting delisted from the American markets. But before we take a look at these three companies, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And of course, today, we're going to focus on three Chinese tech companies that have a ton of future growth potential, and JPMorgan believes they are in a great buying spot at the current prices. And if we jump straight in to stock number one, it is ticker BABA, which is Alibaba. They currently trade for $221 per share, and they're up only 9% over the trailing 12 months. But over the longer term, this company's seen amazing appreciation of over 175% for the past 5 years. They have a market cap at $610 billion and are trading with a very low forward PE of only 21.3 for a company that's experiencing mass expansion. And if we take a look at the shorter share price chart, from a high of over $317, they have now fallen down 30% from this high point back down to their current level. So a 30% decline in this company may lead to a great opportunity to get in right now. And if we take a look at their Morningstar report, they're actually estimated to be undervalued by a significant amount. They are considered 4 stars, which is an undervalued company, and the estimated fair value per share is at $261. So trading right now around 221 is well below that true fair value estimate, and currently around a discount of 15%. So Morningstar likes the company, they believe it's undervalued, and with the future growth potential that Alibaba puts out, getting in at a very low forward PE may be a nice addition to diversify your portfolio on a global scale. And if we jump over to their investor presentation, year over year, top line revenue was up 37%. They have over 900 million monthly mobile active users, which is absolutely incredible. And their cloud network, which is the future of a lot of big tech companies, grew 50% year over year in total revenue, and they posted their first positive year of EBITDA, which is very impressive. And what we can see with Alibaba is that this company is diversified across dozens of different brands. And if we take a look at their revenue breakdown for 2020, 46% came from the China retail marketplace with all of these different companies under their umbrella. Then 34% growth in their total core commerce business. Their online retailers consist of a bunch of different names. They also have the international business like AliExpress, which I'm sure you may have used in North America, and many more. And if we take a look at their valuation framework, they own so many different brands across multiple different sectors of the tech industry. And we can see here that this entire top section is made up of Alibaba-owned subsidies. And in the bottom is all their competitors on an international scale. So in the commerce, they're competing against Amazon, JD.com, and many more. In cloud, they're of course competing with the companies like Google, Salesforce, and many more. In digital, media, and entertainment, they have a bunch of different brands competing with Netflix. And of course, innovation, initiatives, and other, they're competing with different Zoom and Google products. But with this company, they also have exposure into other publicly traded names as well. Ant Group is a financial tech company trying to go public within China at this current point in time, and they have a significant portion of that ownership. As well, they have minor investments in over 20 different companies, publicly and private, with a valuation of over $45 billion in US dollars. So right now, an investment in Alibaba is nicely diversified across different e-commerce, financial tech, digital media, and cloud businesses. And as a whole, this brand was actually under a monopoly investigation by the Chinese government. But just about a month ago, they received a slight $3 billion fine and nothing else. Investors that really led to the sell-off were panicking that Alibaba might get destroyed. But at the end of the first investigation, they were only forced with a slight cash fine, which is nothing for a company if we jump over to their balance sheet that has over $70 billion in USD sitting in cash. So a slight $3 billion fine is pennies for this massive company. And now if we jump over into their financial statements, starting off of course with the balance sheet, over $70 billion of cash, and in total, $91.5 billion of total current assets. And in the short term, total debt is at only $54 billion, so a current ratio above 1 and very sustainable, and the company's total liabilities make up around $86 billion. So currently, their short-term assets of $91.5 are greater than the company's total debt for the entire balance sheet, so I think they're in a strong, healthy financial position, and total equity has been growing exponentially every single year as well. And if we take a look at their income statement, that's where this company gets extremely impressive, and we understand why it's exploded over the past 5 years. Total revenue back in 2016 came in at $15.6 billion. Then, in the trailing 12 months, so over a 5-year span, they've more than 6x their total top line to over $98 billion of total sales in the trailing 12 months, and that has no signs of slowing down anytime soon. And if we take a look at their bottom line, a very profitable company as well. Net profit margins right around 25% is very impressive, and over $24 billion of total profits during the past 12 months. And at their current share price, they sit at $221, which is well below the 12-month expectation from Wall Street at $316 per share, and the current rating is as a strong buy, coming in with a 1.7. So this company is very attractive at this level. A low forward PE of only 21, which is actually below the overall market's forward PE ratio. They've seen exponential revenue growth, total top line expanded by 38% year over year. They were highly profitable. They got through probably the worst investigation from the Chinese government so far with only a slight fine. They're diversified, trading at an undervalued price point according to Morningstar, and offer investors a lot of upside potential over the longer term. So this was the first company that JPMorgan believes is in a good buying spot from a Chinese tech firm with nice global operations and a ton of potential to expand for many years to come. And now if we transition and jump over to the second company they included in their list, it is ticker JD, which is JD.com. They currently trade for $72 per share and are up by 52% on the 12-month chart. The company has a market cap at $116 billion and trading with a forward PE of 39. But if we take a look, this is another brand that's fallen significantly from their 52-week high of over $106 per share. They are now down by close to 32% at the $72 range. And according to Morningstar, the estimated fair value per share for JD.com is at $85. So when the current level sits around 72, we have another undervalued China tech company on the market right now. And if we take a look at their investor presentation, the online retail market within China is projected to grow by 10% annually throughout 2023. And the top 20 digital retailers within China only generated 17% of the country's total online revenue, compared to the United States, where the top 20 brands generated 52% of the total sales. The big names in China have a lot more room to expand. And if we take a look at JD.com's current operations, they reach almost every city and state within China. They have over 900 warehouses, 7 fulfillment centers, and over 190,000 delivery personnel in their workforce. So right now, as the market leading player in the digital retail space in that market, they've done a nice job of expanding to hit all their different bases. And if we take a look, the total CAGR of the digital market within China is growing faster than the big names in the United States, and the leader in JD.com has growing at a CAGR of 31%. And if we take a look at their expansion over the past few years, total revenue is growing like we saw at 33% per year, and their net service revenue, which I think is a very important aspect from every tech company, is growing at a CAGR of 48% annually. Of course, their different merchandise revenue is expanding as well, and the company's total sales in the top line have been growing at an exponential rate. And next, we're going to take a look at the company's financial statements in US dollars from Seeking Alpha. So of course, their presentation has been in the local Chinese currency, but if we transition it over to our local native currency, in the past year, they've generated over $114 billion of total revenue in USD. And that's grown from $37 billion just 5 years ago. And we can see the exponential expansion in the total sales, which is incredibly impressive. And their gross profits are following a similar trend on a nice upward expansion every single year. And they brought in over $7.5 billion of total profits in 2020. And jumping into their balance sheet, another company with a very healthy financial position of over $35 billion of short-term assets with short-term debt of only $26.6 billion. And overall, total liabilities of $30.7 billion is extremely low, and the company does not carry that much long-term debt on the balance sheet, which is very attractive for American investors. And at this current level, they are considered a strong buy, and the $72 price point is once again well below the 12-month expectation from Wall Street of $108 per share. So the company is on a slight pullback of over 30% from their high. They're estimated to be undervalued from Morningstar, and again, another Chinese e-commerce company projected to grow very well over the long term and may provide some nice upside from its current price point of $72. So definitely worth taking a look at. That was company number 2 from JPMorgan's list. And now if we take a look at the third big name that the largest American bank believes is at a good buying point right now, it is ticker BIDU, which is Baidu. They currently trade for $189 per share and are up by close to 84% on the 12-month chart, with a market cap of $67.7 billion and a very low forward PE of only 17.8. And similar to the first two companies we've already gone over in Alibaba and JD.com, Baidu is on a major decline from their 52-week high of over $340 per share. They have fallen by 44% back down to this current level. And from their Morningstar report, the estimated fair value is at $212, and the company is trading at around a 10% discount at this current level. And this brand is known as the Google of China. They are the largest search engine in the country with around 80% market share in that market. And going forward, they're also expanding into different artificial intelligence, cloud-based services to expand their market-leading domination. Of course, they are the number one search plus feed app in China, but they also have a ton of different businesses compounding and growing and contributing to their total revenue. And if we take a look at the income statement in US dollars, they are growing annually, but not as fast as the first few companies. From over $10 billion in total revenue back in 2016 to over 16.4 5 years later. So every single year, total revenue is growing, but nowhere near the exponential rate like we saw in Alibaba and JD. And if we take a look, they are profitable as well, with only $3.4 billion of total net income during 2020. And with regard to their balance sheet, short-term assets of just over $28 billion for short-term liabilities of only 10.4. So a current ratio well above 2, over 2.5, and very safe and very sustainable over the shorter term. And at this current level, the company is considered around a buy, and the share price of $189, sitting once again, like all of the others, very far below the 12-month expectation of $347 per share. So we've seen a common trend across all three big China names in the tech sector. JPMorgan came out with a report saying they like the sector and believe the companies have fallen too hard and too fast and show some decent value. And all three companies are estimated to be undervalued according to Morningstar, which is one of the most highly rated platforms for estimating the true fair value of a stock. And according to average analysts from over 20 to 30 different people from Wall Street, they're all considered a buy or a strong buy and sitting very far below the 12-month expectation for the stock price over the next 12 months. So at this current level, if you want exposure into the Chinese market, now may be the time. Of course, these brands do come with a lot more associated risks, not being American companies, and with the scrutiny of the Chinese government, who knows what will happen over the next few years. But if you're willing to take that risk for the potential reward, make sure you allocate a smaller portion of your portfolio to these companies. They do have strong financials. We went over all the names, and make sure you do very thorough research and speak with a true qualified professional before making any investment decisions. Investing in international brands is always more risky than domestic companies, so make sure you understand the business, you understand the rules and regulations, and what you're buying for your portfolio. So now we're going to kind of wrap up the episode. I want to thank you for watching to the end. Just remember, when the market's in the red, like you can see in my portfolio, it lost over $800 of value in one single day. That's nothing to be worried about. Make the most of these opportunities, buy the dip, and lock in some nice companies with strong growing operations at a lower price than where they were last week. So thank you for watching, and I will see you in tomorrow's episode.